On the Spot with Michelle Makori is brought to you by Meld, the next generation decentralized global bank.
Hello, I'm Michelle Makori. Thank you for joining us. Going into 2023, the broad consensus was that we would certainly feel the dark chill of a recession by the third quarter. Well, so far, the sun is still shining on the U.S. economy. Unemployment is below 4%, inflation is sliding, consumers are still spending, and the S&P 500 rallied as much as 20% this year before cooling off recently, but is still up 16%. And GDP is projected to grow by 1.6% in the third quarter, according to the latest data by the Philadelphia Fed. Meanwhile, several banks have also revised their recession forecasts for this year. Well, my next guest says we are definitely not in the clear and that commodities and cryptos are pointing towards a deep economic slowdown. Mike McGlone is the senior macro strategist at Bloomberg Intelligence, and he's warning that China is showing signs of stress, which will have far-reaching consequences. Mike, welcome back to Kitco. Good to have you.
To have me back. That's a good lean-in. That's a lot there.
Well, we have a lot to discuss with you. Obviously, we want to get your outlook on several commodities and, of course, Bitcoin. But let's start off with your macro outlook. And last time we had you on, you said that we're going to see deflation, that we're going to see the worst recession of our lifetime. And you said that the Great Reset is imminently upon us. And you echoed similar sentiments again recently. So do you still see signs that we can enter what you called a Great Depression?
Yes, well, I hope it's not the Great Depression, but everything seems to be leaning that way. What you led into there with a potential recession in the U.S. is still coming based on Bloomberg economics and based on my views and based on what you see in the things, indications for the yield curve. But it's actually happening already at this point in Europe. The economic revision data that's heading negative in China is getting quite extreme. And I think it's just a matter of time. We're going to see, it's already basically kicking in Europe. PMIs, services, and manufacturing are both negative, yet rates are still going up. See that recessionary trajectory, and there's a war going on. We're certainly seeing a contraction of a slowing of economic growth, and certainly expectations in China. And my question I asked, what makes that get any better with their number one and two customers, Europe and US, tilting that way? And to me, it's just a matter of time that this starts continuing. It's also, the foundation is extraordinary. It's historic. We are just heading towards, we're in the dump phase of liquidity from the biggest pump in liquidity ever, bar none. Maybe in the 1921-29 period in the US was similar. And it's just getting started. It's the key thing I like to point out is in Europe, they still have projections for rates to go up despite the tilt towards recession. The war is obviously still going on. In the US, we still have, if I look on the Bloomberg terminal at the September and November meetings, we still have expectations the Fed might hike rates, still hiking rates. Yet we're at 5.4% upper bound in Fed funds, and CPI is 3% year over year, and PPI year over year dropped to minus 3%. It's the bodies and motions that are very, very disconcerting. Then you look at bank credit clearly declining. Personal savings clearly declining. And the biggest problem is this lose-lose with the Fed still tightening. Part of the reason they're still tightening is because the stock market's going up, partly because it's had a decent amount of fiscal stimulus. But that's a lose-lose. That fiscal stimulus is going to go away, yet that liquidity being taken away from the system, I think, is what's going to tilt everything lower to a normal recession, reciprocal of the liquidity pump that we had that's dumping in. I guess that's kind of the big picture macro.
All right, before we unpack the specifics of what's happening in China's economy, my question has been really about the timing here. Why has the timing been off? There's an expression in the markets, if you're early, you're wrong. So a lot of people have been very wrong, right? So why haven't we seen these cracks happen yet?
So I prefer, and I think it's important to focus on what I got wrong, and I was early, or both first. And that's, yes, I tilted with that recession trajectory. I still agree with it early. I was way early in thinking crude oil would collapse from 120 back down. I still think it's got a lot more to go, just on normal recession trajectories. But it's trying to measure unprecedented pumps in liquidity, unprecedented events, and projecting what's going to happen. So I'm looking back to the macro big picture. We threw so much money at this system. There's still lingering effects from that, but it's going away so fast. Just look at things like mortgage rates and existing homes for sale. They're collapsing. You have to go to new building of homes, new homes under construction, which is almost the highest ever, which really means it's going to peak. And there's just a collapse waiting to happen there as that supply comes on and people just can't buy or sell anymore. So that's one of those trajectories. But I look at it as it's such a big picture macro view. It's such a substantial cycle. It'll be the biggest one of our lifetimes. Now I'm 58. I think I'm using a lifetime. Typical person lives will be around 80. And I think this is going to be the one we're all going to look back on and say, yeah, that was like the Great Depression. The key question is, right, the problem I have with it right now, Michelle, is I don't see what stops it. So typically we'll just give the last two examples of the bear markets in the U.S. stock market. They bottom. Let's just look at 2009. That was the last time we had a bottom in the stock market. And the S&P is up 600% since that period. That's not including total returns, and that's on the back of zero interest rates. Historic. We've never had interest rates that low. But that bottom was in March 2009. The Fed started easing in September 2007. See the trajectory there? We're still tightening. The bottom before that was in around 2002. I think it was Q1. The Fed started easing in the beginning of 2001. They're still tightening. Now, that's just the Fed. Then, okay, that's the world's largest economy, the most significant security, everything tilting that way. And the indicators are quite bearish. Look at the yield curve. The probability of recession from the yield curve is the highest since 1982. Look at leading indicators. It's negative 7.5%, very similar to right before the crisis. So I look at this as the problem is the stock market's jumped this year. It's baiting the Fed to tighten more. And it's the number one thing to remember as markets are all about liquidity, that liquidity is still being pulled. And at some point, to me, the number one thing that the bottom line that has to happen for the Fed to start easing, the stock market has to go down. It's the lose-lose at the moment. For now, with the Brazilian stock market predicting potentially more and more animal spirits and inflation and sticky measures from the Fed, they're going to just keep tightening. Why should they cut until the market makes them? And that usually means the stock market.
Okay, before we get into your outlook on the stock market, let's bring it back to the bigger picture and macro. And of course, you said that China is a big key in all of this. And there's that expression, China sneezes and the world catches a cold, right? So we know China, second largest economy in the world, and we are seeing signs of slowdown. The economy expanded 6.3% year over year in the second quarter, below estimates of 7.3%. First quarter GDP there was 4.5%. Again, assuming we can trust this data coming out of China, because there has been speculation that it's often revised to look a lot rosier than it is. But we also know that China is dealing with deflation for the first time in 2 years. Consumer prices falling 0.3% in July. And on top of that, and very significantly so, we've got China dealing with a property crisis. China Evergrande Group, which is China's second largest property developer by sales, has now filed for bankruptcy protection. And in China, as you well know, Mike, the property sector accounts for more than a quarter of all economic activity. So this is a big deal. And in the last 3 years, we had more than 50 Chinese developers defaulting or failed to make debt payments. That's according to S&P's credit ratings agency. So we see that China is already cutting rates in response to slower growth. The People's Bank of China cut its 1-year rate, which is the rate that most of China's households and business loans are based on. They cut it in June, and then they recently cut it again in August. So, and of course, this is going against the trend of other central banks. So how does this China slowdown start to infiltrate the U.S.? Play that out for us. How does that happen?
So it's a train wreck just getting started. What you described, there were bodies in motion with very little to stop them. I view China right now as some combination of the novel by Ayn Rand, Atlas Shrugged, peak Japan, and peak Soviet Union about 30 years ago. This massive upward trajectory in China GDP growth from around 4 trillion, which is where China is, to almost 20 trillion, has so much room for reversion. And that's what's happening now. And there's a significant trigger. Now, you mentioned things that, remember, also, number one, China's not China anymore. It's one person. That's why I go to Ayn Rand, the calamities of an autocratic-led country. It's one person, President Xi, and he made the most significant, I think, catalyst trigger that we're going to remember in history, and that was this unlimited friendship with Mr. Putin right before the war. And now what's happened? The U.S. and Europe have significant reasons to pull back from anything importing from China, doing anything with China, investment, importing, and data's already kicking in. I'm kind of shocked how fast it's happening. U.S. total imports from Mexico now are now exceeding those from China for the first time in 20 years. U.S. European imports from China are turning over rapidly, and it's just they flipped the switch. I don't see what's going to make it better. And I've been speaking about this for years, but now it's become consensus. And I see it from my colleague, Joe Weisenthal, just did an Odd Lots podcast and just pointed out all the things from the inside scoop in China. I have colleagues now, we can't publish things. We can't put our name on things about China because we risk detainment and things. So that's how bad it is. So you can't really trust anything they say, but watch what they do. So I mentioned what Mr. Xi did with Putin, and what did he do with Jack Ma? We saw that really pushing against free market capitalism. So to me, this is the trigger. This is a flip for China to do what Japan did when they peaked. The Nikkei peaked in 1989, and what the Soviet Union did when it peaked around 91 with the wall falling down. And the question is, what gets it better? I don't see anything there. A key thing I was going to get to, I'm glad you mentioned, is look at interest rates. Watch what they do. When we had this big upturn in risk assets and commodities up to the peak, it was really peaked at 08, then back up to 2013. Interest rates in China were higher and going upward versus US. Now we have the complete opposite. The 2-year note yield in China is 300 basis points, about 300 basis points below that of US. US rates are going up rapidly and they're declining in China. To me, that's a train wreck that's happening. US is hiking rates rapidly. It's going to squish us, US into a recession. The demand pull, biggest importer on the planet. China is cutting rates to try to help boost exports, yet where are they going to export to? And then you mentioned property. So we all know that's about 70% of most household wealth in China, if you can trust the data. But from our strategists and analysts in BI, it's just getting started. Question is what stops it. Now, we should fully expect some form of stimulus, but the lessons I've learned is you can't really just provide stimulus to people in China, because that takes away power from the Chinese Communist Party, which is used to massive infrastructure projects. So they've already built most everything they needed to build. And I look at this as just a classic simple cases of parabolic, rapidly increasing economies that revert. It's just happening, and we're seeing it in slow motion. Question is what stops it. So to me, that's part of that massive deflationary force. That's part of a global economic reset. Look at Europe; it's basically already in recession. And there's sort of in China, the data, can we really trust it? Yeah, we know where that's going. So the one key thing is the U.S. and what triggers the U.S. to tilt back downward is, it kind of goes to the stock market. But the U.S. and Europe are still hiking rates, biggest customers of China. So there you have it. Those are the three musketeers, I guess, of global economy, and they're all starting to head negative.
I mean, we're certainly seeing signs of weakness in Europe. I believe Germany reported very, very weak GDP. The UK is practically on the brink of a technical recession as well. But you sort of mentioned how the US is getting more imports from Mexico, and that leads into the whole disengagement idea.
There you go.
Which has been pushed. So does that offer some kind of buffer perhaps for the US, that there has been active disengagement from China, meaning that the US is less dependent on what happens in China?
This situation, I think, is the trigger for the U.S. to crush it on a global basis. I mean, to literally look what's happening with the dollar. The BRICS are trying to get.
What do you mean by crush it?
To crush to be the world's leader, to regain in terms of doing very well on a global economic scale without doing anything, but just via the system. The system in China is proving it doesn't work in a rapidly advancing technology, autocratic leader. Now, Deng brought in rapid capitalism, and Xi is bringing it the opposite and going back closure. But what's happening is with this war, everybody realized, okay, do we want to be under the protection of Russia and China or the protection of US? US isn't perfect, but the alternative is much worse. What's happening with the dollar? I mean, here's the kind of thing I like pointing about the dollar is with the BRICS trying to get together. If you look at every currency in the BRICS, Brazil, Russia, India, and China over the last 10 years, they are melting currencies versus the dollar. The dollar is not perfect, but it's the least worst of those. And then we have this little war going on in Europe. To me, that's the trigger that is going to prove that the autocratic leadership and the problem in China is just going to do a little reversion like Soviet Union and Japan did. It's way overdue. And who's the shining star in all this? The U.S. Who's the biggest producer and exporter of energy? The U.S. What was the problem last year in Europe? Energy and agriculture and the dollar. And I'm not, obviously I'm a yank, but I'm just pointing out facts of trends. And then I'll end with this. Then you look at the most significant new technology on the planet over the last 10 to 14 years was cryptos. 90% of all so-called stable coins, almost 98%, have gone to the dollar. The dollar is the base layers for cryptos. Why? They could have gone to the yuan, the euro, the yen, or the ruble. They went for the dollar organically because it's the best place to go for transacting in currencies. And then there's things for investing. Bitcoin and gold are in that space.
All right. Well, you mentioned the BRICS summit, and we do know that the BRICS, Brazil, Russia, India, China, South Africa, are meeting in Johannesburg right now. One of their high agendas is de-dollarization, is moving away from the US dollars, trading in their own currencies. But from what you're saying, it doesn't seem like you're particularly concerned about that as an imminent threat.
Oh, I've heard it. I'm only 58. I've heard it my whole career since the 80s in the trading pitch. So I'm like, good luck with that one. They're melting currencies. Remember, that's the whole idea for things like the gold standard and things like Bitcoin is offsetting these propensity for countries that do not have the checks and balances that we have in the US and Canada and most of the European countries that can support a currency. Now, here's the fact right now is, yes, the U.S., the dollar's perfect. You just look at, let's just look at the Chinese yuan. Last 10 years, it's down 20% versus the dollar. Let's look at the Indian ruble, 20% also. I'm looking at the rupee. Yeah, exactly. Rupee. Yeah, exactly. Brazilian real, 50%. Russian ruble, 65%. Okay, so they need to do something because are their systems going to get better? Maybe. But here's the situation right now is the world's deepest and safest treasury market, which they don't have any near close. It's also a problem with Europe. They're all disparate, is giving you almost 5%, over 5% overnight rates, risk-free. The US dollar, it's like unstoppable. Anything, you look at the top other currencies, look at what's the next specific country, China. Well, their 2-year note rates are 2% or so. Let's look at Japan, the next most significant country. Rates are basically about zero, maybe a couple basis points. And then Germany, maybe 2%. That's unstoppable for the dollar right now. They can't compete with that. Yes, the U.S. might do something wrong, but just the fact that U.S. has raised rates so much, that is an underpinning for the dollar, and that's why part of the rest of the world, the BRICS, have to do something. And I like to say good luck until this flips, until the Fed starts easing and helps them out. This is a really bad situation for countries with melting currencies. BRICS all have melting currencies.
Okay, so you're not concerned about de-dollarization, at least anytime soon. You do see disengagement happening between the US and China, but you do still fear that China could be a big catalyst in bringing down the US into this Great Depression, if that's an accurate summary.
I wouldn't say so much Great Depression. I'd say significant deflation. It's deflation and recessions are synonymous, economic contraction. But to me, it's global. To me, it's just typically what happens in cycles. I think still like the dollar, that the U.S. is going to be coming out of it the best. I think China has the most downside, just simple reversion. Europe, I don't know how they're going to work. South America, Mexico probably do okay because they're next to the U.S. Canada probably okay. But just it's the macro of the biggest risk is China, I think, should export these deflationary forces.
Okay, but you've said the worst recession in our lifetime, right?
Yeah.
If that's an accurate rephrasing of what you said. So what does that look like? I mean, what does that look like in terms of markets? What does that look like in terms of GDP? What does that actually translate into?
So let's look at US, for example. Normal recessionary correction means probably you usually get peak to trough, the S&P to correct at least stock market, at least a third from the peak. Now it's still almost near that peak. So I think that means it gets near 3,000. That's very simple math, partly because where was the market right before COVID? Right around 3,000. Now that's the US. But what has the most risk to drop more? Just think about China has a lot more risk on the downside. Who is their best export customer, US and Europe? If they're going down, it's the one that the fastest horse in the race has to go down the most, particularly when they're probably never going to get those exports back ever again. I mean, they're done. Just unless there's a change of sentiment significant there. So that to me is the macro. It's deflationary. It's really bad for things like commodities, probably good for gold. How far it goes, I don't know. But here's the point right now. This is the current trajectory where we're going. We're seeing these tilts. We're seeing these recessionary inklings. We still have sticky inflation in some countries, not in China, and PPI in US is negative. And the bottom line for me, Michelle, is predicting where it's going to go is harder, and where it's going to land is harder. It's the fact that the bodies in motion are getting worse. I mean, rates are still going up in this country despite indications for, here's the key thing I'll end with this. The producer price in this country just dropped at its fastest pace in history. 18% was the peak last year, minus 3% that was this year. 1 year dropped 21%. That's never happened since 1948. If there's not an indication of something big's happening, and has happening, there's a good metric for that.
So you have more conviction now than you did when we spoke last.
Unfortunately, because the last time we spoke, the Fed, there was a potential maybe the stock market would roll over more. China didn't look as bad as it did. Europe wasn't in a recession. And the Fed, there was already expectations we might cut rates at the end of this year. The thing is, that dangling carrot's gone. If you look at Fed funds futures, I love to look at them in 1 year from now. It's the 13th contract typically. They're hovering around 5%. There's no hope of liquidity. So I look at it as if we get to this recession right now, and the potential for the Fed to throw in that liquidity like it has in the past during major recessions and stock market collapse is not there at the moment because of what's happened in the past. We created too much inflation with too much ease. The lessons of inflation and too much liquidity will resonate, I think, for a lifetime, meaning every time that we start thinking about QE or Fed easing, there'll be warnings. So, you can't because of inflation. You don't want to create that inflation again. We're not even there yet, but that's what I'm anticipating.
Okay, so what are you anticipating from the Fed then for the rest of the year? Sounds like you see another hike coming.
Well, it's very simple. I look at Fed fund futures and it's priced for another hike, 30% into the November meeting. So now, the way we stand, that's the problem. And the Fed's made it clear is we will not be cutting rates anytime soon unless something makes them. What's going to make them cut rates? We all know. There's bottom line. The number one thing is some kind of collapse in the stock market, typically some kind of event which comes from a collapse in this market or leads to it. So that's the lose-lose. There's no reason to add liquidity until we see a decline in risk assets. Now that's starting in things like condos and housing prices and the inverted curve, but it hasn't hit the number one high beta leading indicator in the plan, and that's the U.S. stock market.
But we have starting to see it hit the banking sector, especially earlier this year, and we're seeing some more warning signals from the banking sector. I mean, Moody's cut the credit ratings of 10 to mid-sized and small U.S. banks recently. This week, there was a downgrade from S&P Global Ratings for more banks, including KeyCorp and Comerica. We also had Fitch reducing the overall operating environment of the banking sector at large, which they said if that worsens, that could force a cut to banks, including the likes of JP Morgan. Would you say that the banking sector is able to withstand another hike? How confident are you in the overall health of the banking sector, considering we've had this aggressive Fed?
There you go. Those are bodies in motion. What stops it? So credit contraction, money leaving the banking system means fractional reserve basis. You cannot lend more. You have to lend less. So we're seeing that contraction in credit. It takes a while. It works with a significant lag. What you pointed out to me is a train wreck that's happening. What does it take to stop that process? Typically, you need some kind of extended lower plateau and a decent lag to massive liquidity being added to the system. Fed Reserve easing. They're still hiking. Now, of course, we have this election coming up. We can get into that later, but that to me is what's the point is. Now, what happens oftentimes is rating agencies are lagging. They point out the obvious. Markets do it ahead of time. And this case, I think they are pointing out what everybody knows is there's clearly credit contraction. Just look at trying to get a mortgage now. And even if you can afford it, it's almost double the cost it was just a few years ago. Those to me are the key points. Those bodies' emotions aren't going to stop without a good reason. And bottom line is, number one, on a 1 to 10 scale and everything, is the U.S. Federal Reserve is still priced for more tightening.
Okay. So what are you expecting to hear out of Jackson Hole, where we've got Jerome Powell, Christine Lagarde, other central bankers and economists? What did you say you're expecting to hear from Jackson Hole?
Vigilance, the same.
Oh, vigilance. Okay.
Yeah, sorry, and I should have let you finish. I apologize.
No problem at all.
I enjoy this. I enjoy that sun in New York in your background. We get that New York feeling. Kind of miss it, having moved to Miami, but we get it a little bit here. Just not as much as where I am. But that's the sign. That's the sign of New York. It's like I got to pull out my New York accent a little. But no, I think he's going to be the same old vigilance. Our economic team says he might point out some of the things that I'm sure he's going to point out things that are going the proper way. But the way I see it right now, Chairman Powell, to meet his goals, and he has said for a while that is to curtail and squash inflation, has every incentive in the world, I think, to ride the same course, and that is we will remain vigilant against inflation. It's still above our target. Personal consumption expenditures, employment cost indices are still 4%. Their targets too. They will get to 2, and they will drop below 2, in my view, and they will collapse and get negative, in my view, based on the base effect and what typically happens in cycles and the major lag to this significant tightening. So I don't expect anything but I wouldn't know if it's hawkish, but more vigilance. We will maintain rates, and I think the market's got it priced right that this the WIRP function on the terminal, which shows me what the Fed's going to be doing in the next few months. It shows 10% they're going to hike in September and 30% they're going to hike in November. I don't think there's a reason to take that out until markets, i.e. the stock market, tells them to take that out.
But do you see any further hikes beyond an extra 25 bips by the end of the year? That's
the problem. If there's more animal spirits, stock market keeps going up, sure, the market's still priced for more hikes.
It wouldn't just be a hold it at higher for longer? Wouldn't be like, okay, one more hike, but we're going to stay steady?
He could do that, but I think if he considers his cost benefit analysis of making the market think that, why bother until it's more obvious? And I just sense from his rhetoric, which started in December, I think it was actually November 21, when at that meeting, might have been October 21, when he first started pointing out these facts. To pivot in Jackson Hole, maybe, but I don't see why. And that's part of the reason when you look at the stock market up 15% this year, it's already telling them it's kind of a double dog dare. Yeah, it has been surprisingly resilient in the face of all of this, which is, has many people are looking very wrong with their predictions of what they expected the markets to do. I want to bring it back to what you said we're seeing from commodities as indicators here. And talk about oil specifically, as well as some of the other commodities. We know that China is the world's largest oil importer. We've discussed the reasons for concern about China's economy. So break that down in terms of what it means for oil and how that does also point towards that deep economic slowdown and the deflation that you're forecasting. So I'll reiterate my call, which has been early, and some people might say wrong, but it's in the right direction. I think crude oil, WTI, is going to head towards $40 a barrel, maybe 50, 40. That's been kind of an enduring price since the peak during the Iraq, when Saddam Hussein invaded Kuwait. And I didn't say Iraq, it was Saddam Hussein. I was in the trading pits then. And that's a very deflationary commodity, but I still think it's going to get there. Now that's the macro. The macro is, here's a simplistic view of crude oil. It's the world's most autocorrelated commodity on the planet. The price right now, around $79 a barrel, was first traded in 2007. Every time it goes up a lot in history, economies in supply and demand and elasticity respond. It goes down, and it has to go down to reverse that. If you price oil right now, it's, in terms of gold, 0.042 ounces of gold will buy 1 barrel of crude oil. That was the same price as 1931. That shows you the autocorrelation of what really drives oil. It's the debasing currency. So that's the macro. The micro is we're seeing more supply coming back on potentially from Iran. The most significant thing that's pressured oil in the last decade or so, since the peak in 2008, which is still the high, was massive excessive production, overconsumption in the US and Canada. US consumption peaked a long time ago. The world's going that way. Remember, the world's largest importer of crude oil now is a net exporter. That's the paradigm shift that people missed last year, and I still like to point out. And it's getting more significant. I wouldn't say worse, it's getting more. I mean, I drive an electric car, drive electric bikes, have solar panels. Where's that going? The point is, for crude oil to go higher and sustain higher from here, China needs to be massive demand pull. They're not. Supply has to be curtailed exactly. You have to have technology go negative and backwards. It is not. It won't. In this country, we get almost 15% of unleaded gas from ethanol now. So the situation of crude oil is quite negative. What's more significant commodities is copper. Now, copper in the big picture is harder to produce. It takes longer lag time. You can store it, so it's easier to invest in. But it's also in this commodity, in this economy. We all know that's going decarbonization, electrification. Everybody gets it now that you need metals, you need copper. But look at China. That's a massive. Will's number one demand pull for copper, heading lower. So on the year, copper is basically unchanged. Crude oil is down about 2%. Gold's up about 5%. That, to me, is something just getting started. I see deflation in fossil fuels, most notably crude oil, probably sparking inflation in the price of gold. Now, I've been early. I've been a little bit wrong. Some might be able to say, sure, Bates, but it seems to be going that way. And I don't see what stops it. And the bottom line, also, key thing that needs to be roped in is we are still pulling liquidity from the system, but there's something that's more simplistic from a investor trader standpoint. It's the futures curve. And that is, we're going to probably go down in history as Mr. Biden being one of the best traders of crude oil in history. And I know people don't like to say that, but when he sold from the SPR, he sold into backwardation, which is the essence of the right thing to do. When you're in backwardation, you sell when prices are real, when the spot's giving you high. You can just buy back a few futures at lower levels, take the delivery, boom. It's called management of inventories. What's happening now, though, with interest rates so high, if you look at crude gold, the 1 year contango in gold, I mean, that future gold is about 6%. That's just measuring one thing, interest rates. All that's trickling down to commodities. So what does it mean now in commodities? Now you're supposed to be selling. If you get more contango, we're all heading towards contango, which means an oversupplied market, and you're more likely to hold your inventories and you sell forward to take in those futures. So this is a massive shift. The big picture macro is bad from China, and everything I see, like I said, crude oil still heading towards 40. Copper is probably, it's per pound. The way I like to look at the per pound because it's it's around $3.80 a pound. I think it's more likely to go to $3. The price right now in copper is the same as about 2007. It made a new high, but I think 2, 3, 4 years from now, copper is more likely to continue and extend that high. And which just end with this: crude oil made a peak in 2008. It bounced again in last year. It's an enduring bear market that's heading back downward.
All right. So Dr. Copper indicating a slowdown, a recession, and you're saying crude is consistent with that narrative. A very interesting take on Biden being a good oil trader. I've got to tell you, that's the first time I've heard that. But does have
I had to mention it, but I think history's going to judge it. It's kind of
does have some validity. I mean, you could question the national security reasoning of selling off the strategic petroleum reserves, but if he sold it when they were high, he can refill them when they're low. I mean, I guess there is something to that, to be fair. What is gold telling us then? What is gold indicating, and what is your outlook for gold, Mike?
So I will stick with my theme in gold, that I think the price of gold is going to get above $200 per ounce and never look back. Now, it's had some major reasons. $2,000 an ounce. Yeah,
you said 200. 2,000 to be clear. Yes.
Oops, I missed the zero. So thank you for correcting me that. So I think it's going to get above that key resistance level. It's basically a triple top. It's been bumping up there for a few years now. But what's really pressuring gold right now? There's a very good reason for pressure on gold. It's the cost-benefit analysis of the U.S. Fed funds rate of 5.5%. That's pretty good pressure for a asset doesn't earn any interest. And then this has been this outperformance of the U.S. stock market. So at some point, you see where the trigger is. The U.S. stock market has to start outperforming. Once that happens, you should get a Fed pivot, not right away. And gold, I think, should be one of the better performing commodities. It's one of the few commodities I'm still bullish on. And it shows, you look at the average price of gold this year, it's around $1,940 an ounce. Did I get the zeros right on that one?
You did.
That's the highest ever gold price. Now you can't say the average price this year. Now we're August 23. It's just a matter of time. But so to me, that's what's going to happen with gold. It's still a reserve asset. I just want to piggyback on one other thing about crude oil, and I'll just end with this: is the U.S. and Canada combined on a daily basis, the surplus of liquid fuel supply versus demand is about 4 million barrels per day. That's enough to fill up the SPR in about 60 days, or to refill it. So it's not needed anymore like it was before in 1979 when I was a gas jockey pumping gas. We had a little crisis over in Middle East, and we had to price gas in, of course I say gas, we had to, not petrol, in half gallons because the analog systems were not configured to price it over $1 per gallon.
Okay. I know you keep on saying you're going to finish with this, but I'm not letting you go anywhere until you get your thoughts on Bitcoin, Mike. Digital gold, but just to be clear, you see gold hitting 2,000 when the Fed starts to cut, and you're anticipating that happens at some point in the second half of 2024?
So exactly, the timing is subjective. I've learned that lesson the hard way. Here's one example. Just today on the 23rd, gold's up a full percent just because interest rates have dropped. If you look at the number one bond ETF, TLT, is up 2%. So the market's anticipating that this big pump in yields and rates is rolling over, and that's what it's going to take for gold. How it happens, when it happens, markets oftentimes look ahead, and sometimes if you have a plunge in the stock market, it'll take a little while, like 2008. Gold went to 1,000, dropped to 700, and then it went on this big run to 1,900 in 2011. I don't know how it's going to work out, but I think for long-term investors and for just looking at the performance, it's at some point it's going to break out higher. And I think the trigger is going to be once we can see the light at the end of the tunnel, the Fed to really start easing and hint at it, and what's going to take for it to happen. And I think that's where the flexion comes in. I think gold has to not have that competition from the stock market anymore, which is way overdue. The stock market, like, earnings are so much more, you can get so much better returns. You had the highest short-term yield rates in the U.S. since 2001 and in treasuries.
Yeah. Let's focus then on digital gold, on Bitcoin. You had a note recently out titled Reversion Risk, where you said $7,500 Bitcoin, $57 crude, and $2,900 for the S&P. But we've covered those assets, even though you've subsequently revised your oil even lower. But let's talk about Bitcoin. You're saying it's at risk of falling to under $8,000. I know long-term you're bullish on Bitcoin, that you've said you think it's the greatest asset on the planet. We'll get back to that. But in the near term, how do you get to this $8,000 number? And over what time frame, more or less? So
the key thing, that numbers, those levels you mentioned, those were the 50-week moving averages at the end of 2019, right before we had that big pump in liquidity. So we have to go back to levels that really matter. And I've knocked this around for a while. So basically around 10,000 in Bitcoin, around that level is where the market was before this biggest pump in liquidity ever. It went to 69, and now we're back in still, I think, a bear market. Crude oil was right around $60, 57. Now it's gone within 10% of that level. So there's the autocorrelation of crude oil. It was at that level right before the big pump in liquidity, and it's back down. The most significant one of that that's going to matter the most is, I think people need to never forget in markets from where they're from. Where did the market come from before this event happened? So normal reversion in a normal recession for the S&P 500 is probably around 3,000, particularly if we tack on what we did in terms of pumping liquidity in the system. The 50-week average right before COVID, 2019, at the end of the year was around just below 3,000. So I've heard pushback is people say, oh, it's so different in Bitcoin. The problem with Bitcoin is it's a baby. It still is the highest volatility in the space. Yes, I see all the big picture, I still agree with it. Decline in supply. It's going to become global digital gold. But the problem right now is it's the best performing asset in the history of the world. And what really created this asset to perform so well? Digital gold in a zero interest rate environment? Yeah, okay, that works. We're going digital. Now that was what pumped Bitcoin to the best. It's still, if it drops to 10,000, it's still probably the best performing asset ever. So that to me is a problem. In a shorter term, that's the macro. If we have this downturn, you just take money away from everybody, which is kind of a rule in bear markets, Bitcoin will suffer. The key point is we need to see at some point it to start showing divergent strength where it trades more like treasury bonds and gold in a deflationary environment. And it hasn't been doing that. It peaked basically at the end of Q1, got to around 31,000 on this hopium and ETFs, and it's dropped back down around 25, around 26 now. It's showing divergent weakness to the stock market going up. I need to at least see signs of as a trader, as an investor, you need to see signs of the oomph. And then you look at overall all the other altcoins. I mean, a lot of them could go to zero with what's happening with regulation. I mean, are they not securities? Why not? I mean, so this is what I see for Bitcoin. It's the number one crypto that matters. I think eventually it's going to get to 100,000. But if we get the global economic reset, I think we get a normal deflationary recession, housing coming back down, stock market coming back down, similar to 2008, but this is actually in some cases worse because we're still taking liquidity from system. Bitcoin is a great leading indicator, and that's my point. Lately, it's been kind of leading the way down. It got up around 31,000, and it's been tilting back lower. So I'm looking at it as a leading indicator for most risk assets.
Okay, so if we do have this recession, which you're forecasting, and everything goes down and Bitcoin goes down right along with it and perhaps even underperforms other assets, what does that do to the argument that Bitcoin is supposed to be a store of value asset?
It's too early. It's only it's a baby. It's only 14 years old. In the long term, I completely get big picture. To be able to transmit, transact value on your phone and keep it in your head is a revolutionary technology. So I like to compare Bitcoin. The rally in Bitcoin was very similar from basically 10 years ago to the peak in 21, 22. It was very similar to the stock market in 1921 to 1929. And the big difference is the Federal Reserve started cutting rates in Q4 29. The difference is right now we're still taking away that liquidity. So this is going to happen. I think it's going to, but not without bumps in the road. So here's a simple fact. The 100-week moving average of Bitcoin is trending down, most significant in its history. This is what you expect in an asset that's maturing. And the recent bounce was near that average. So trend is heading lower and the Fed's still hiking. There's bad things going on for Bitcoin in the macro. Now in the micro, we still hope to get those ETFs in the US. At some point it'll happen. But even if the ETFs come on, and when they do, they'll come. Where's that money going to come from? From people who are typically invested in equities. If you're losing money in the equity market and your volatility is 10, 20%, and you can get 5% in 2 notes, and Bitcoin volatility is 50, 60%, Bitcoin's still a toy. And so I think it's going to take time. We got to get through this. And maybe I'll be wrong about this great reset. If that's the case, then maybe Bitcoin will be a leading indicator on the way up. Now, just remember the thing, Bitcoin trades about 3 to 4 times the volatility of gold and the stock market. So it should be a leading indicator, but it's also been, people talking about declining Bitcoin volatility lately. And I point out, well, it's been about the same versus stocks and gold because volatility's dropped in everything.
All right, well, you mentioned the spot Bitcoin ETF, and of course, there's a lot of speculation that BlackRock may get its ETF approved, considering that there's such a successful track record with BlackRock, the world's largest asset manager, getting ETFs and other products approved by the SEC. And then we've also got the halving in April. And many guests on the show have seen those two forces as very strong catalysts for Bitcoin to really rally next year. Does that happen if we have this turn down? Do those factors negate the turn down? Because it doesn't sound like you think they will based on what you just said.
What I'm really concerned about is the lessons from Benjamin Disraeli. He points out, the former UK Prime Minister, is what we mostly widely expect typically doesn't happen. What you mentioned is what I hear every place I go. I'm like, yeah, I know. We all know that. I think, your average 12-year-old knows that. And I don't mean that. I mean, it's priced in. We get it. Everybody says the same thing. And that's why I was concerned about, well, what are the unknowns here? What are the risks? So having absolutely cut that supply, yes, but it's completely predictable. I love pointing out that the actual supply of Bitcoin annual increase is going to drop close to 1% annualized. Gold's average historically is 2%. That's great. That's bullish. We all know that it's to some extent priced in. But the point I like to make is this recent little pump we saw and got to around 31,000 was so suspicious to me when everybody was pointing out the same stuff. And then I look over, what's the Fed doing to help you in the macro? They're not. So
why was that pump suspicious?
Oh, because everybody said the same thing. It's based on the ETF going to be launched. This is something that it's complete no. There will be ETFs that track a broad-based index of cryptos at some point in the future. We launched the Bloomberg Galaxy Crypto Index in 2018 for that reason. That's 5 years ago. It's just right now, it's just a question when it happens. And that's why I'm not good at predicting that kind of. My ETF strategist here said it could not happen, might not happen until next year. But then it also assumes all the flows are going to come in. And here's the point about Bitcoin. The price right now is about the same for 3 years. Volatility is 50%. That's 2 to 3 times almost every other risk asset. And it's still kind of a toy for a lot of these investors who might be going to the ETFs. If things start changing where they realize this rally we've had for the last 14 years is going away and reverting basically what the Fed is planning, then it might take a little while for Bitcoin to catch that bridge. So here's a simple fact. The point I like to point out is Bitcoin was hovering around 10,000 before the big pump in liquidity. I know things have changed. I know on-chain metrics have increased, but there's a potential we can easily get back there if we get the reset I think we're going to get. I mean, crude oil's already done it. Crude oil's a different asset, just about done it. So I do appreciate the...
But you don't see the whole angle of institutional investors coming in and push. Go on.
Completely. But it's just, I get it. Once it hits the cover of Time Magazine or Wall Street Journal or New York Times, it's a complete no. To me, here's a.
So that's all priced in. You're saying institutional investor interest is priced in.
I wouldn't say it's priced in, but it's expected. I'm viewing it similar to at the end of last year, the beginning of this year was completely expected that crude oil would go higher because of the China reopening and the big pump that would create in global economy and in China. It didn't happen. It's just it's one of those things of this tweaks my little thing. Like everybody kind of agrees on the same thing. All right, show me the performance. Show me the outperformance on a volatility weighted basis. And like I point out, if you look at Bitcoin in the last few months, it's dropping, stock market's still going up. It's not showing you that potential for what the narrative says.
Right, but just to push back on this idea of institutional investors not necessarily being so significant on the price move, I mean, if you do have a spot Bitcoin ETF, you're going to need to have physical possession of Bitcoin, which means that by default, there will need to be more Bitcoin bought, and this is an asset with limited supply. So when you're still gonna have more demand to fulfill a spot Bitcoin ETF and limited supply. So wouldn't that, just by the fundamentals there, force a price move?
Depends on how much they buy, and never forget from where you're from. Bitcoin, I need to reiterate, Bitcoin is the world's best performing asset in the history of mankind. No, and nothing even close. And it happened during zero interest rate policy, and right now you get 5% until you know.
Okay, well, let's bring it into one of your quotes. And you've said that Bitcoin's days of big pumps may be over as mainstream adoption rises. Exactly. Now, to me, that indicated that we're going to have more big players. So it'll be harder to have a giant move. But at the same time, you're still saying you're seeing $200,000 Bitcoin. I don't know over what price point, but I know last time we spoke, you said $100,000 Bitcoin by 2025. That's still a pretty big pump, if that is still your view.
So this is 2023. That's maybe pushed back a little bit. Based on supply and demand, I like that scenario. Still kind of going there, but it depends on how that was before the facts have changed. The lessons of Keynes. The facts changed when we had this big pump of liquidity that's dumping. That to me is the biggest thing about Bitcoin. And the best way to describe it is it's coming to mainstream. There's one thing I'll point out. One thing I did get right. It was this launch of the futures. It was just this tremendous. It squashed the volatility because it was a tremendous risk arbitrage cash and carry trade. It was just so free for a little while. The money was too easy to be able to buy Bitcoin, sell futures, lock in, and just trade around it. That's happening a little bit now in GBTC with that huge discount and people doing that trade. It's getting arbed out. But that's the whole thing about institutions getting into space now, Michelle. It's the days of Bitcoin or the years of it going up 100 to 200% are done. It happens in infancy. Now I think with volatility, it's going to trade more like gold and stocks and treasury bonds. And that's the trajectory. Volatility right now is 50%. It's 2 to 3x the stock market. It was almost 10x just a few years ago. It's getting squashed, that volatility, which means it's not going to have that outperformance. And the lesson I like to learn is Bitcoin. It's a lesson that one of my favorite technical mantras is it's going to go up because it went up, or it's going to go down because it went down. That has been the case in Bitcoin and the stock market for the last at least decade. And there was a good reason for it: liquidity. The liquidity is still negative at the moment. And this is something that hasn't happened in my lifetime. We've seen this much negative liquidity, despite things like leading indicators showing we're going to have a recession. Now, Bitcoin is still a risk asset. It's gone up a lot. And I can see it getting back towards that mean around 10,000. Long term, I think it's one of those things that's supposed to be a buy and hold. But for traders who bought around 31, they might get stopped around 15, make a new low, maybe a double bottom, and then maybe we'll see where it goes. But again, this is the part of the macro it fits in. It's just the leading indicator. If it's such a good leading indicator, why is it doing so poorly in the last few months? Okay. I think it's because, to me, it's indicating the tilt I'm expecting, and that's towards this great reset.
Okay, so in this great reset tilt, you see Bitcoin dropping as low as 10,000. But you threw out that 200,000 price target I
think you threw that one out. I'm still looking at six figures, 100,000. But
okay, no, I'm sure. I think you said 200. I apologize if I misquoted you there. But so, okay. How do you see the 100,000 there?
So I kept that same level. That I think I put that out 2019 or so, 20. And there was good reason for that: the supply declining, demand increasing adoption, Bitcoin ETFs, everything I saw was happening. And it's still there. It's just a classic case of we have an asset here that's really early days in global adoption. You can see that in hash rate and everything. And there's limited supply. It's basically set up for the number go up mentality to work well. But it already has. That's the bottom line. Never forget from where you're from. Bitcoin went from around 10 to 26 now, on the back of money supply increasing around 40%. Okay, the amount of Bitcoin in terms of dollars, and that money supply is negative right now.
Right. Well, if it hits 10K and still rallies up to 100K, that's still a pretty serious pump, right? Depending on when you get into the trade. So that's still a 10x appreciation there. Mike, before I let you go, is there anything that derails your thesis here? Is there anything that happens that you could foresee derailing this whole great reset thesis and tilt that you've laid out so articulately for us this whole interview?
My first thought is some form of definitive peace in Europe, new regime potentially in China, a major shift towards, this was a big mistake. We're not going to be doing this anymore. We're opening up to free, open elections, to capitalism, and we're not going to be trying to repress people with these two big countries with just two people, with two leaders, President Xi in China and President Putin in Russia. Now, there's a risk there that the way things are going right now, there could be some nuclear issues. And this is a hot war going on. Hopefully it won't go that way, but I'm more worried about the downside. The upside would be wonderful if that happens. Other than that, we are in trajectories that are almost unstoppable, as we pointed out earlier. Bottom line is we still have restrictive money supply, despite most indications showing that economies are tilting towards recession.
So some miraculous overthrow of power in China that would, in a very short period of time, lead to a full-on democracy and open markets is what could derail this. Very unlikely that happens, though, of course.
Maybe some tomorrow, maybe a switch in the party. I mean, it's something, who knows? I can't predict it, but to me, to answer your hypothetical question, to me, that's a major repression on a global scale. That would just give us like a VE kind of day. I mean, this is a significant Cold War going on right now. It's just playing out. Some people have called it a World War III. And there is that hot war going on in Europe, and there is nuclear threats. So hopefully that won't happen. But remember, it's the autocratic leaders of these countries. It's not the countries, it's the two specific leaders. And as we kind of anticipated, the average person has no desire. They'd rather kick back and watch an American movie and have a soda or something, I think.
All right. What's your favorite American movie? Mike, final question.
Okay, so let's go back to the history. The best movie ever is Chitty Chitty Bang Bang.
Wow. Okay. Interesting selection. I'll have to revisit that one. Wow. Okay.
There was an article recently in the New York Times about that property that Caractacus Potts was supposedly living in England, outside of London, is for sale.
That is what? The vehicle?
Well, so they filmed it at a farm with a big windmill. Okay. That's still there. And so it's actually, that farm is for sale, that piece of property, that land. So if you're interested, Michelle, maybe you should go take a look at it.
I'll take a look at it. But first, I think I need to take a look at Chitty Chitty Bang Bang again and sort of refresh my memory about that one, if it's your top movie pick. Mike, thank you so much. Really appreciate your thoughts on so many topics. Thanks as always, Mike McGlone.
Thank you for having me.
All right. And a big thank you to our sponsors, Meld Finance. Remember that there is a special offer for Kitco viewers in the description of this video if you're watching us on YouTube. From me, Michelle Makori, and the rest of the team, thanks for watching. We'll see you soon.
On the Spot with Michelle Makori is brought to you by Meld, the next-generation multi-chain crypto wallet that allows you to unlock the value of your crypto without liquidating your position. Undertake easy cross-chain transfers, yield, and borrowing by handling your crypto and fiat processes with transparency. Transfer fiat to and from crypto exchanges at low cost and in 15 currencies. Meld, your one account for money and crypto at your fingertips.